get on board Amitava Mukherjee, the Chairman and Managing Director of NMDC Limited and NMDC Steel, who's now joining us. A couple of things that we need to discuss about the tariff jitters in the global mining industry, the domestic metal industry, and of course the growth roadmap ahead for NMDC. Thank you so much, Mr. Mukherjee, for taking the time out and joining us. Mr. Mukherjee, first up, several moving factors on the global front. Now with China-US trade deal on the back foot for the time being, coupled with increased tariffs on steel imports into the US to a 50% now, how do you expect the global factors to evolve and the impact on the global iron ore market?
If you see the numbers, US actually imports around 22 million tons of finished steel, of which 45% is from its neighbor Canada and Mexico. And a substantial other part of it is from their own ally countries like Japan and Korea and others. So China's share in their import has come down to less than 1 million ton since before even the tariffs were imposed, around the time the tariffs were imposed. So naturally, I think the effect of that would be marginal. And some amount of Chinese steel has always been flooding the international market, keeping the prices down. But thankfully, because of this duty that has been there, I think the market has stabilized within India. And we are concerned about supply of iron ore within India because we hardly export any material. So now I believe the situation would at least be stable, and that has been stable for the last couple of months, last 1 or 2 months, especially as compared to the HRC prices. Of course, there has been a little downturn in other billets and long products. But overall, the market is not looking too much downwards in terms of iron ore pricing, if you see. So it has been a steady market. We hope that the stability would continue for some time if there is no upturn.
Okay, Mr. Mukherjee, also help us understand what about domestic iron ore prices? The imposition of safeguard duties on steel have seemed to have had, they've supported domestic iron ore prices, but is the trend likely to continue? And also, are you penciling in some price hikes over the next 2 to 3 months?
There would be a stable market going for the next few months, both in terms of steel prices and definitely in terms of iron ore prices. I do not see too much of a downturn and neither too much of an upswing in prices. The prices has been reasonably stable. I think the maximum delta that would go on will be plus minus 200, 250 rupees. Nothing very substantial in the next couple of months. That is my prediction. But when we go to do pricing, we'll have to look at the numbers much more deeply and accordingly make the pricing.
Right. Also, NMDC has set an ambitious target of 55 million ton for FY26 versus an earlier 44 million ton in FY25. Does strong and resilient domestic market really fuel the solid 25% growth confidence for FY26?
This growth of FY26 is essentially based on domestic demand. We are, of course, having a pellet conversion agreement with KOICL, whose plant was idle, and we are using that plant for making some, hopefully we'll be able to make some DRI grade pellets there for export. That will be possible. But overall, I think our growth projections are based on domestic demand, which I believe that there will be substantial, at least for the quality of ore that we produce. We shall not have any problem in selling it the same in the market. So going forward, I think 55 million tons, if we which we expect to produce, I don't think marketing that would be a major constraint. Most of our major customers have substantial ramp-up plans. I think our own company, which is NMDC Steel Limited, is going up from 1 million ton to more than around 3 million ton, which will more than double the iron ore requirement. So RINL has ramped up. It took only around 4 to 4.5 million ton last year. We expect that the current ramp-up plans of RINL, and if they start the third blast furnace, they would require more than 9 to 10 million tons. So I think overall, our customers, other customers are also having good plans of capacity expansion this year itself. So I think we should have an easy sailing in terms of dispatch and sales.
Okay, and Mr. Mukherjee, let's also talk about your capex plans, because NMDC has spent 3,700 crores, approximately that amount, on capex in FY25, and you have guided for 4,000 to 4,200 crore capex for FY26 as well. Help us understand what this will be used for, and over the next 3 to 4 years, what would be your capex guidance, and by when does the company aim to reach that 100 million ton capacity mark?
I have been always been saying in various fora that we would be investing around 60 to 70,000 crores for our capex expansion, for our expansion plan, from 50 million ton to about 100 million ton. Now, of this, around 30,000 crores is already sanctioned or already under execution. So whatever is sanctioned is under various stages of tendering, etc., etc. Another 13,000 we expect the sanctions to be given by the board within this quarter itself. So that will take the entire sanction book to around 45,000 crores. Apart from that, we have around 25 to 30,000 crores of capex plans which are currently at the drawing board. So by the end of this fiscal, we expect them to be also duly sanctioned. So going by that, because the capex in the first year we take around time for tendering and then mobilization, etc. So this year we have a rather small target of 4,200 crores. But going by the sanctions already obtained and tendering under process, etc., I think we should be able to do around 10,000 crores from next year on, because we need to finish this entire 60 to 70,000 crores in 3 to 4 years. So the average spend will have to be approximately around 10,000 crores a year, which I believe we'll be able to do from FY27 onwards. FY26 will be doing 4,200 crores.
Right. Also, I believe that NMDC is diversifying beyond the iron ore into coking coal, copper, lithium, cobalt, nickel, gold and bauxite, targeting a portfolio of 10 strategic minerals. Now, what is the strategic partnership, the roadmap ahead for this diversification?
It would partly be domestic, in the sense we have already got 2 coal mines in Jharkhand, that is Rohne and Toki Sud, which we expect to get operational in this financial year. And the rest of the diversification into these 10 minerals that you have said, which the board has mandated this company to go into, would essentially be from our international forays. So we are looking at a lot of proposals very closely from Africa, from Australia, from Indonesia, even some from South America. So we have a structured way of evaluating them. These are at various stages of evaluation. In some technical due diligence is over. In some we are into legal and financial due diligence. So these are at various stages. So hopefully within this financial year, we will be able to have interests or acquire some of some of these assets. Some of these are coking coal, some of these are lithium, some of these are other minerals, as you stated. So we are hopeful that by the end of this year, our portfolio of foreign assets would substantially increase, which is currently only a gold mine in Australia. But by the end of this fiscal, I think we should be able to do much better.
Okay, and also NMDC is evaluating operational coking coal assets in Indonesia, Australia, like you just spoke about, and other regions. Help us understand, what are your plans? What are some geographic expansion plans as well?
So obviously, coking coal, it would not make quite sense to have absolute exploratory stage assets outside. So that is why we are much more interested, at least in coking coal, in operating stage assets and not in pre-operating stage assets. There are there is a churn in the coking coal market worldwide, in the sense assets are changing hands very frequently, if you keep a note of that. And I believe that we need to be in the market to evaluate those assets and acquire them if they are otherwise a sound investment decision.
Also shed some light on any international acquisitions that are on the anvil, and if at all, how will they be funded?
They will be funded on a mix of equity and debt. definitely. We need to de-risk our international operations because we are being rather aggressive. But in that aggression, we need to take care that these are not too risky. Just aggression should not turn into a risk. We are aware of that fact, and hence various models are being worked out. And obviously, the entire funding would be a mix of equity and debt. Some amount of equity will have to be infused. Some amount of debt will have to be taken.
Okay, and let's also talk about your Nagarnar steel plant that became EBITDA positive on a month-on-month basis in March to April of 2025. How do you expect production and sales to ramp up for the steel plant, and consequently, how will profitability inch up higher?
We expect at least the Q1 of this financial year to be at least not only EBITDA positive, but also PBT positive and PAT positive. That's what our expectations are. On many techno-economic parameters like the coke rate, like the what we call the PCI rates, we have reached well above industry standards and much better than our compatriots in some of the public sectors as well. So going forward, I think we are targeting a capacity utilization of around 90 to 95%. We are already at the 80% mark if you see on an annual basis. On a monthly basis, if you convert into an annual basis, so we are almost at the 80% mark as of date. So we need to ramp that up. We are slightly less than 80%, but we ramped that up to around 95%. And given that the techno-economical parameters have also been rather good, so we expect this year definitely to be a profitable company. NSL would have turned around completely and fully this financial year, starting with Q1 of this year.
All right, thank you so much for joining us on the show. We will let you go on that note.
If you like this video, then like, share and subscribe to ET Now.